In 2023, a big increase in famous American companies going bankrupt is causing concern in the business world. Over 230 companies filed for bankruptcy this year, twice as many as last year and the most in over a decade. This financial change is due to factors like higher prices, supply chain disruptions, Federal Reserve interest rate hikes, and changes in lending practices. Industries like consumer products, manufacturing, finance, and healthcare are hit hard. Apple shares have dropped by 3 to 4.5% today, and the broader stock market is down by 21%, with Dow Jones falling 18%. We will discuss 10 notable bankruptcies in various sectors today to understand why they happened and their impact on industries. Let's kick off our exploration with companies in the retail sector. First up, in the middle of January 2023, Party City, a popular party supply store chain, filed for bankruptcy due to several challenges. These included the helium storage in 2019, affecting their balloon business, increasing pandemic-related costs, and consumer spending slowdown due to inflation, along with tough competition from online and large retail rivals. To address its financial issues, Party City secured a $150 million bankruptcy loan, crucial for keeping its operations afloat while restructuring its $1.7 billion debt as of September 2022 with limited available cash at $122 million. As part of its recovery, Party City is considering a significant transformation, potentially closing some stores to reshape its retail presence for a more sustainable future. Next up, we have the home goods retailer Bed Bath & Beyond. In April, Bed Bath & Beyond, a home goods retailer, filed for Chapter 11 bankruptcy due to struggles in the digital market competition against Target, Amazon, and Walmart. This company's previous expansion efforts in the 2000s failed to establish a strong online presence, leaving it unprepared for the shift to online shopping. With declining revenue and high debt, Bed Bath & Beyond reduced features and inventory. After narrowly avoiding bankruptcy earlier, the company had to temporarily close stores and seek buyers for certain parts of its business, signifying a major transformation amid challenging times. Moving on to number 3, we have the Rockport Group, a well-known player in the footwear sector. Despite reporting strong revenues for over $203 million in 2022, the company faced unexpected financial challenges and filed for Chapter 11 bankruptcy in June. The surprising decision was primarily driven by a critical factor: Rockport's insufficient cash flow to handle additional economic pressures. Despite its impressive earnings, Rockport found itself burdened by nearly $100 million in funded debt obligations, with a significant portion due to mature in August. Notably, the company owed approximately $47 million to its top 5 creditors. Rockport, famous for its comfortable rubber-soled casual shoes and with a legacy dating back to 1971, has gone through various ownership transitions over the years. These include periods under Reebok, Adidas, and a collaborative partnership between Berkshire Hathaway and New Balance. It's worth noting that this isn't the first time the company has faced financial difficulties. In 2018, Rockport underwent a reorganization strategy that involved the closure of its US-based retail stores. Now, let's turn our attention to number 4, the discount home goods retailer Tuesday Morning. In February, the company filed for Chapter 11 bankruptcy protection. During this filing, the Dallas-based company disclosed that it had secured a commitment of $51.5 million from Invictus Global Management. This financial support was meant to sustain the company's operations throughout the bankruptcy proceedings. It's worth noting that this isn't the first time Tuesday Morning has faced financial challenges. In 2020, it also filed for bankruptcy due to store closures brought on by the pandemic. During that time, it had to shut down several locations and undergo restructuring. This time around, Tuesday Morning is planning to shutter unprofitable and underperforming stores as a cost-cutting measure to move forward. In its Chapter 11 filing in 2023, the company reported having assets and liabilities ranging from $100 million to $5.5 billion. This marks the third instance of the company seeking financial relief despite the obstacles it has encountered along the way. Moving on to number 5, we have the prominent e-commerce platform Boxed, which specializes in wholesale consumer goods. This platform found itself caught up in a challenging financial situation. The company's decline, marked by a drop in its stock price and market capitalization, indicated underlying causes that become more apparent in the months before the bankruptcy filing. To make matters more complicated, Boxed had financial connections with Silicon Valley Bank, which was facing its own difficulties. In response to these challenges, Boxed made a strategic decision to wind down its retail operations and divest its software business. This move reflects their commitment to adjust their course in the face of adversity and navigate through these tough times. Moving on to number 6, we have the renowned wedding gown retailer David's Bridal, which also found itself wrestling with financial strains and eventually opted for bankruptcy protection. The company's journey through financial troubles was made even more challenging by its prior announcement of workforce reductions affecting thousands of employees. Although David's Bridal had previously navigated a bankruptcy in 2019, the pandemic-induced disruptions in wedding-related events events, along with changing consumer preferences for wedding attire, pose significant challenges. Despite recent increases in wedding celebrations, ongoing operational difficulties related to shifting post-pandemic trends, and broader economic uncertainties all indicate a tough road ahead for the brand. Moving on to number 7, we have the mattress manufacturer Serta Simmons Bedding, which took the step of filing for Chapter 11 bankruptcy protection in January. The company's financial difficulties were compounded by several factors. Notably, ongoing litigation related to the emergency funding it obtained during the pandemic had already been a concern. This was made even more challenging by slow sales due to the recent turbulent economic conditions. As a result, Serta Simmons Bedding found itself burdened with a substantial debt totaling $1.9 billion. In response, the company initiated a restructuring effort with the aim of significantly reducing its debt burden to $300 million. To facilitate this process, the mattress manufacturer also proactively addressed the litigation associated with the pandemic-era funding it received, adding another layer to its comprehensive strategy. Now let's shift our focus to the telecommunications and technology sector with number 8. On May 24, 2023, Quail Tech Services Incorporated, headquartered in Pennsylvania and offering a range of services to the telecom and utility sectors, voluntarily filed for Chapter 11 reorganization with the U.S. Bankruptcy Court for the Southern District of Texas. Alongside its 17 affiliated companies, Quail Tech disclosed assets and liabilities ranging from $500 million to $1 billion. Next up, number 9. On April 28, 2023, Internet Holding LLC, based in Georgia and offering data center and network solutions, initiated a Chapter 11 bankruptcy proceeding in the U.S. Bankruptcy Court for the District of Delaware. Operating under the name of INAP, along with its 3 affiliated companies, the company reported assets and liabilities ranging from $100 million to $500 million. A joint reorganization plan was proposed, outlining the payment of certain claims, either in full through cash or with shares in a newly restructured entity. However, it's important to note that general unsecured claims and existing equity interests were not slated for distribution under this plan. Number 10. On June 4th, 2023, Cyxtera Technologies, a firm specializing in data center services, initiated a Chapter 11 reorganization process in the U.S. Bankruptcy Court for the District of New Jersey. The company, along with its 15 affiliated entities, reported assets and liabilities within the range of $1 billion to $10 billion. Cyxtera's total outstanding funded debt, amounting to $1.01 billion, comprised $864.4 million in first-line term facilities, $97.1 million in a senior secure asset-based revolving credit facility, and $50 million in emergency bridge facility. These developments highlight significant changes and challenges in the data center and technology services industry. In a year filled with financial turbulence, these 10 shocking bankruptcies of 2023 have left us with a lot to ponder. From retail giants to tech innovators, these stories highlight the unpredictable nature of the business world. And with the largest bank on the brink, the situation is indeed alarming. Stay tuned as we continue to explore the ever-changing landscape of finance and business. Don't forget to like, subscribe, and hit the notification bell for more eye-opening updates. Thanks for joining us on this journey.